Hello and welcome to the Archon podcast. I'm your host, Valeria Salazar, here to interview Eric Weissenen and Ethan Wood, co-founders of Astrovault and AMM building on Archway.
The views, thoughts, and opinions expressed are the speaker's own and do not represent the views, thoughts, and opinions of Phi Labs or the Archway protocol. The material and information presented here is for general information purposes only.
Eric, Ethan, welcome. We're so happy to have you here. If you watched last podcast, you'll know that Eric is usually on this side of the podcast. He's usually a host, but today he is our guest as one of the co-founders of Astrovault. So if you guys want to go through introductions, we'd love to hear more about you.
Yeah, so my name is Ethan Wood. I'm the co-founder of Astrovault, which is a new AMM being built on Archway. We are focused on realigning incentives and generating revenue from sources outside our user base.
Eric, would you like to give an intro on yourself?
Sure, yeah. So I'm Ethan's co-founder. He started the idea and I helped form it. As you guys know, with Phi Labs and Archway, I am the token economics lead, and that's kind of the role I usually take. And so we came with this idea that we wanted to fix AMMs as a whole. We want to bring DeFi to the everyman. We want, whereas traditional finance reserves the right for people to lose their own money for people with over $250,000, we want everyone to have the opportunity to lose their own money instead of paying people to lose money for them. But it really, DeFi is the future. And we need these institutions in place that are decentralized, but do have logical business models. And right now we think that AMMs not having logical business models is really, really holding them back, which is one of the things that attract us to Archway as a whole. But that's why we wanted to take a new stab at it, an AMM that generates revenue from its TVL instead of TVL just being the denominator really when trying to factor what real yield is, and something that's really a negative metric for most AMMs.
Great. So before we get into the nitty gritty of what Astrovault does, would you guys like to tell me a little bit more about your crypto background and how did you guys enter the cosmos?
Yeah, so I come from more of a corporate traditional background. I started out in like fraud work, low level, and worked my way up the corporate ladder doing business administration and global trade compliance for companies like Hewlett-Packard, Verizon, AT&T, and kind of stayed in the traditional tech sector for several years, quite a while actually. Kind of just watched crypto on the sidelines for a number of years, just kind of wanting to see what happened with regulations. And I was really nervous, I guess, about the way the government was going to approach crypto from a regulatory standpoint. And so I stayed out for a while. And during, I guess, it was probably 2017, somewhere in there, I really started to get involved and really started to deep dive and get into these projects and really look at the technology, reading white papers and just immersing myself in the market. And through my travels, I ran into Eric in the Cosmos, and we were both saying the same things, that these projects need to have viable business models, that this just doesn't make sense. We're just printing money and just throwing it away. Like, what are we doing here? So Eric and I were both singing the same tune, and we ran into each other, and it was just like a match made in heaven. But I'll let Eric go on.
Yeah, so a much less professional background. I got into college for free, so I'm like, I might as well take some classes. Got into economic philosophy because, there's tons of things you can do with that degree. And I got into casinos because that's one of the few things that game theory really is applicable. I got into card dealing, card counting. I found a bunch of issues with the game theory in games, so I got into game auditing and game design and creation. And when I got banned from everywhere card counting, I needed a new side hustle, and some coworkers of mine showed me like, hey, get into this new crypto stuff. Check this out. And we started day trading and yield farming and really exploiting current economic issues, and just kind of got more and more involved because I was passionate with the idea, but also frustrated with the execution. And through joining different communities, I met Ethan, and we're like, how can we actually make a difference and kind of lead people, like lead the horses to the water so that there's actually something to drink from. And we've been focused on Astrovault ever since.
Awesome. Very interesting. So what can you tell us about the current state of DeFi with the FTX collapse and everything? There's a lot of pressure in the ecosystem. So what are your thoughts around that?
Yeah, things are definitely bearish right now. I won't sugarcoat that. I will say that our protocol is designed to sequester and build a treasury of liquidity, and there's no better time to accumulate than in a bear market. So realistically, we're not in a terrible position. We're pretty much the answer to all the shenanigans that happened at FTX. Like, that stuff literally is impossible in our exchange. This whole idea that we need to trust centralized third parties with our money is nonsense. Like, DeFi already exists. We need to implement better systems and systems that are sustainable and systems that have an adequate business model. But I think DeFi is the clear answer.
Yeah, a lot of people really are blaming crypto for what happened with FTX, and really FTX is what happened to crypto. And we're trying to bring the tooling of how banks operate, where you can give transactions to the everyman, give ownership of one's funds and one's future to the everyman without this risk of centralized parties running away with your money, which is still there with banks and is still there with centralized exchanges and entities such as FTX.
Okay, great. And Ethan, you mentioned creating sustainable models. So what do you believe is unsustainable in Web3 in its current design?
That's a really broad question because most of Web3 is unsustainable from my perspective. That's a really broad question. I can limit that a little bit to like the AMM space. As far as sustainability with AMMs go, one of the things that most people aren't considering is that if you have a period at which your inflation ends. Let's say inflation runs for 4 years, right? When that 4 years is up, that's a shelf life on your product, essentially. When you have no way to incentivize liquidity providers to stay there, they're not going to. They're going to go somewhere and pursue a higher APR. And that's what we see in the market. We see this AMM death spiral, right? AMMs, they first incentivize their liquidity. The liquidity comes, they get a high APR. Then sell pressure reduces the token value. The lower the value of the token, the lower the reward APRs go. Liquidity then leaves in pursuit of a higher APR, like I said. And then the AMM has little to no liquidity and an asset that's worth, basically nothing to incentivize liquidity to return. So rather than fixing that model, currently in the market, most people are just giving up and launching a new AMM and repeating the cycle. And that is both disturbing and disgusting. I think you need to stand by the products that you build when you put something out there, and you really need to work on creating a solution that lasts long term. If you're going to put a product on the market, it can't be dead in 2 years. That's just not acceptable. But we see the turnover over and over and over again in this market. We see all these DEXs popping up and dropping, and it's just because we're doing the same thing over and over again and expecting different results.
Yeah, absolutely. Okay, so let's dive in. So what is Astrovault and how is it different from current AMMs?
So Astrovault is a new version of the AMM. Basically, it's a hybrid AMM that fuses an X times Y equals K, like a traditional AMM model, with our proprietary model plasma pools, which is a one-to-one swap, essentially. So what this enables is the use of staking derivatives as base pairs. And what that amounts to is all of our liquidity earns rewards. So if you can imagine, like if Osmosis was earning staking rewards for all of the liquidity on their platform, how much revenue would they be raking in? And then you take on the fact that we're built on Archway. We have additional revenue streams from our contract premiums, from gas rebates for developers because of the wonderful things that Archway has to offer. And beyond that, we also have a few additional sources of income from, like I said, the various layer one chains of the Cosmos. So we have, over 10 streams of revenue just from where we're built and just the basic features of the Cosmos and the way that it functions.
Okay, great. And so do you want to walk us through the structure? So plasma pools, nebula pools, and all that?
Yeah, so Ethan mentioned two types of pools. Nebula would be these base X times Y equals K, but in these Nebula pools, instead of the layer one assets being hosted directly, we're going to be hosting a non-auto compounding staking derivative, which wouldn't make sense to use outside of our, but does make sense for platforms to use to capitalize on TL, which has not been done, as I mentioned, in previous AMM models. And then with this X Atom, this X Arch token, you can hold that against, say, the other X Atom or X Juno or X Osmo or where else we want to host against it in this X times Y equals K fashion. And then we've got these plasma pools that trade one-to-one, which can then swap these X tokens, our non-auto compounding staking derivatives, with the underlying asset. So you don't have to wait this 21 to 24 day period for an unbonding time. People ask us, why would we use your staking derivatives? Because you won't even know. If a user comes in, they just want to trade Arch for Atom, they just trade Arch for Atom. What happens on the back end is Arch will either buy or mint X Arch, depending on what's cheapest for the user. They don't have to worry about it. Then the X Arch will buy X Atom in the Nebula pool. Then the X Atom will convert for regular Atom on the other side's plasma pool at a one-to-one rate, and you don't have to worry about all the intricacies. But and it'll still have the cheapest fees and be the easiest user experience of anybody who's used AMMs. It really is looking quite beautiful. But what this enables for us is to actually tap into the Atom and the Arch staking rewards in ways that their AMMs have not been able to capitalize. And since we are a tool, we are a service that other layer ones need. Like everybody needs liquidity. You could go pay like $15,000 a month or something the market make for you on centralized exchanges. We can actually decentralize the payments for market making by going to these layer ones directly and being like, hey, you don't have to give us anything. You don't even have to give your rewards to other people, like is being criticized, being done on Osmosis Frontier. Like you just keep your money, take these ecosystem funds, take these community pool funds or whatnot, and host them in a plasma pool. You still own them. These funds for you aren't doing anything anyways. It allows us the opportunity to arbitrage across our staking derivative, which gives us more staking rewards. It lowers the selling pressure of these tokens, raises the bondage rate, and secures the networks. And then we take these staking rewards and we add them back to the plasma pool as protocol-owned liquidity, and giving people the opportunity to liquidate their X assets for the underlying assets sustainably. And arbitrage will continue to grow the liquidity. And we use the term autogenic because it grows upon itself and it grows upon that growth. And realistically, this ends up being a liquidity hub that is not reliant on this external liquidity that can be bought and sold, and you're trying to retain it for another day, another 2 weeks. We eventually can completely turn off rewards, and at that point we have our own liquidity. We don't need to have APRs anymore. We still have buyback and burn pressure from the fees on the Nebula pools. We still have increased protocol and liquidity from the staked assets we have, as well as from the fees on the plasma pools. So it is a sustainable model built on the Cosmos, built in the Cosmos, built for the Cosmos, which can then really expand to all of the proof of stake networks.
That's a really great value proposition. So breaking this down a little further, why would a user be incentivized to trade on Astrovault as opposed to Osmosis or another AMM?
Well, for starters, we have trading incentives. We actually have a cool little mechanism called Gravitate, which is not really a standalone token in itself. What it does is it allows you to claim a percentage of the available AXV to subsidize your trades. So the way this works is for trading on the platform, you can actually redeem a certain percentage of AXV to cover the cost of your trading. That's something that I don't believe Osmosis has at this time.
And just going more like party by party incentive analysis, it makes most sense for traders to trade where there's the most liquidity and where it's the cheapest fees. So we have the cheapest fees. If we get the most liquidity, we'll have the lowest slippage as well. But then how will we get that much liquidity? And then it makes sense for liquidity providers to liquidity provide where things are most profitable, as Osmosis has deprecating rewards and like really, really low real yield, which as they isn't really appreciating at this time, like that they're going to have to make some adjustments. A lot of things could be listed on Frontier with no boosted rewards, or they have to supply their own rewards. It's like, well, if we can guarantee those rewards as well, because we can justify them by earning revenue directly from the layer one chains we support. And then since these new, especially the new chains, but a lot of the old chains as well that have low liquidity, that need liquidity hosted, we can offer more services, better services for far less money. So it makes sense for us to be the choice. And as we are that choice, then we are the liquidity hub where we have the most liquidity and the lowest fees, where then it makes sense for us to be the trading place for the end user.
Okay, great.
Well, and not to mention, it kind of comes also for me personally as like if I'm just thinking as a user, if I just put my user hat on, the rewards token that I'm earning matters. The utility or the value of the underlying asset of the platform makes a difference. And if we're just printing rewards, then what is the value? So our token actually has a treasury that backs it. We have a treasury made up of all of the tokens of the Cosmos that we support, right? So that backs our token. That provides some inherent value to it. You can participate in our DAO. You can deploy the treasury. You can do all manner of things. So what is the utility in a token that doesn't have a treasury as far as governance goes? Is it just a suggestion box? Because that's what we see in most Web3 projects right now, is just a virtual suggestion box. And we wanted to create something more. We wanted a token that actually has utility and actually has power and ability.
Right. Okay, so you mentioned Gravitate earlier, Gravitate incentives. So how are Gravitate incentives redeemable? And when you redeem those, how does that benefit users?
Our goal with setting up Gravitate was we want to incentivize traders. We want traders to get a part of the inflationary side of the counter-inflationary token that is AXV. And in order to do that, like it's really risky. If we have something like, print AXV when they trade, that's gameable. If there's a flash loan attack, like it could break our model. If we have something where it's constantly accruing and then like the next trade gets it, some people will like if no one's traded in several blocks, get far too much for a small trade. Some people will not get anything or nearly enough for a small trade. Like it's too sketchy. Like we need some kind of queuing system or claim system. And some people try this with NFTs, but that's a little bit inefficient. So while some people have read our white paper and told us like, oh, so this is a 2-token platform. Like, no, Gravitate is it is a fungible token, but it's non-transferable. It's non-tradable. It will not have its own price. All you can do with it is claim your percentage of AXV that you're awarded from it. So basically, there's a constant drip from the AXV emissions that will go to this pool that's claimable equally by all Gravitate tokens. And so if a bunch of people are trading, then a lot more Gravitate's printed, then that's raising kind of the denominator of how much AXV you can claim. And so each Gravitate will be worth less AXV. If very little people are trading, then each Gravitate is worth a lot more AXV, and incentivizes, especially trading on the plasma pools where the trading fees are really, really low, and balancing them where it can be literally profitable. So arbitrage on a slippage-free pool is a very interesting concept we dive into in the white paper. But yeah, for the user, it makes the net trade fee on plasma pools about 0, and it makes the already low trade fees in the nebula pools even that much lower.
Okay, great. So essentially, it's a buffer into protecting AXV tokenomics while still incentivizing users, correct?
Well said.
Yeah,
okay,
absolutely.
Cool. And so what other utility does the AXV token have? Why would someone want to hold the AXV token?
If governance tokens goal is to govern, and Ethan mentioned earlier that pretty much currently they govern parameters, some govern community pools, which is great. It's still only going to govern itself. If we were just a governance token, which we are more than that, we would govern a lot more than anybody else. What we can do with our governance token is not only govern parameters, not only are the token holders beneficiaries set up as a Panamanian foundation, which govern the DAO-owned treasury, but also we relay the governance power of the staked layer 1 assets we have to the AXV holders. So if you're able to, say, claim an AXV airdrop or something, like, yes, you can sell it, and that's okay. We don't have a 3,3 mentality. We're built to last. If the price is lower, then more gets bought back and burned from the trading fees. Or you can stake it, and you can stake it to earn more AXV and vote in AXV, and that's great. Or you can stake it and earn Atom and vote on proposals 88 and 89. Or you can stake it to earn Archway and vote on Archway proposals. Like, with our token, without voluntary contribution from other assets that get listed, we will be able to sustainably give people rewards to participate in layer 1 governance, which has not really been done, especially at scale, for layer 2 applications before. So we do consider AXV to kind of be an index of the Cosmos ecosystem, and to be a governance hub of the Cosmos ecosystem, especially as we diversify in different staking pools, different governance power, there may be a disproportionate governance amount of governance power in AXV holding pools compared to that same number of tokens on the layer 1 asset themselves.
That's fantastic. So that's tying back to the fact that you guys have staking derivatives on the platform.
Those are our base trading pairs. So all of our liquidity is routing through those derivatives. Like Eric said earlier, again, we wanted to make it so easy that your grandma could use it. So you don't have to know what a staking derivative is or any of that to come in and use and trade on the platform. Like he said, it all takes place behind the scenes. We made it very, very easy to use, and had a real strong goal of keeping the barrier of entry extremely low. I think that's kind of a problem in crypto in general, is we have kind of a high barrier for entry. You have to go to all these different exchanges and use these bridges and we wanted to kind of create a one-stop shop. That's why we're partnered with Cato.money to bring in the on-ramps and some of those capabilities, and off-ramp as well. And yeah, all that.
Great. So by holding just AXV, you're able to participate in the governance of any and all trading pairs that exist on Astrovault, correct?
You don't need to hold AXV to use Astrovault. You don't need to hold AXV to liquidity provide on Astrovault. You don't need to hold AXV to earn AXV and sell AXV. But we will make sure we capitalize on whatever you have to do to earn and dump AXV. For example, right, Ethan mentioned earlier that currently in AMMs, there are these kind of like death pools that like you need the price of the governance token to be high in order to bring in liquidity, but eventually they sell and they dump that token and then they move on. Well, the way a lot of AMMs are currently trying to set up in order kind of like as a stopgap to prevent those kind of mechanics is making every pool a death pool. And the death pool is the pool that gets spiraled down, the one that has the highest APR because it's positioned against their governance token that eventually is the one that just gets dumped on. And now we're seeing more AMMs force all the pools to be paired against their token, be like, no, you have to route through us. So now we're kind of like a Mexican standoff type thing. Like if you want to earn our token, you have to have our token. If you're going to try to sell our token, then you're going to sell your other tokens down with it. Like if people just want to hold Atom and Arch, they can liquidity provide just Atom and Arch. They don't have to use the AXV token, and we'll give them AXV for it, because the way they're doing it by chasing these APRs and selling our token, that's fine. But now we're earning Atom and we're earning Arch. And as people are trading through those pairs, it is automatically buying back and burning our AXV token, justifying consistent codified buy pressure with it. So yes, you can farm our token and you can sell our token. You can do that with any AMM. We're still standing. Like you can't break our model. Whereas everything else, if you sell it and it goes to zero, everything leaves. If you sell us, we can't go to zero, because if anybody's trading, it's still adding buy pressure. The 0.2% fees and nebula pools go to buy back and burn the AXV token. And if you're providing liquidity to farm it, we are earning the staking rewards from the liquidity you're providing.
So essentially, when you hold AXV, you not only can participate in Astrovault governance through the DAO, but you can also participate in the governance of any and all Cosmos L1 tokens that are being LP'd on the AMM, correct? Without even have to trade or hold those tokens.
Yes.
That's very revolutionary. That's very exciting.
DAOception.
Right? Yeah, DAOception. I like it.
Absolutely. So bringing it back to Archway. So why did you choose to build on Archway?
Yeah, that's a great question. So Archway is aligning incentives for the architects of Web3. That's kind of their bread and butter. On Archway, you have a direct portion of the inflation reserved for the people actually building. Like I mentioned earlier, you've got gas rebates, you've got contract premiums, so creators can monetize the contracts that they write. They're really realigning incentives and thinking about these problems from an economic standpoint. And that's something that we both share. We're offering incentives without any accountability, like I mentioned earlier, in the market. And I don't like to see that. I like to see people contributing value back to the people who are building. As a layer one, I think it's important, especially a starting up new layer one, it's important to draw in builders and to really have a diverse community that comes in and builds and contributes to this burgeoning network, right? So I think Archway is better positioned to do that than virtually anyone else in the cosmos with their incentives. And that all adds to our revenue streams, and just, like I said, it was a match made in heaven.
Yeah, I couldn't agree more.
I'm going to sound a little bit like a Cosmos heathen, but going to the root of what app chains mean and entail is that in order to get this a better autonomy of your chain, this more freedom, I suppose, you have the higher expenditure of having to have a whole bunch of nodes operate and incentivizing node operators and having protocol developers. It's really, really a lot of extra added costs. And if the benefits aren't there to justify that, I don't think that's a sustainable model. And I really like Archway's approach at lowering the barrier of entry, which is, in my opinion, the biggest thing for an AMM to be its own app chain. And I'll explain what that means in a second. But also providing the protocol devs, providing the validators and whatnot. Like, there's a lot less that we have to do because we're building as a layer 2 instead of a layer 1. And all of those extra things we'd have to do are costs. It doesn't lower our revenue. It just raises our costs to launch as a layer 1. And so Archway's stance of like, hey, we'll give you our rewards. Like if it's in fact protocol thesis, we'll give you part of our protocol. If you build something that's sustainable, part of them being resourced to the point where they raised $21+ million already and are still raising more to build something that's not a flash in the pan, but that is going to last more than 5 years and will still be here around down the road while other people are experimenting, gives us as founders the security and the confidence to come and build here if we're built to last, if we're building something that's revolutionary, that's not a cash grab or a flash in the pan. And that's where we see ourselves. And if we adopt to the point where we're filling too much of the block space, or there's so much built in Archway that we really do need additional chain, they've already offered and said that they will help us migrate, use interchain security with Archway, and help us with validators or whatnot, where we can always spin off and make ourselves an app chain in the future. So we're never limited, but it makes us a really nice, easy testing ground while as layer 2. And so I mentioned importantly about lowering the barrier of entry. And that's a huge thing that's really dissuasive if you're launching as a layer 2. If you're an AMM, it's like people are going to come here to buy and sell your tokens. But if they don't have the gas token, then they can't even use your AMM, which means that people literally have to go use a different exchange, have to use your competition before they can even use you. And that's like, that really, really hurts like the ability for adoption. Part of the great thing about Osmosis is that like they had 0 fees so people could come use it. Now we're not going to be able to control the Archway fees, and the Archway fees are not going to be 0, which in my opinion is definitely network good. But what we can do is, as we're getting these gas rebates and rewards, is we can now allow people to have their first several trades on Astrovault. We will pay the gas for that, which means if you don't have Arch, but you want to try out Astrovault, you can come with no Arch to Astrovault. We will pay the Arch and gas for you to go buy the Arch token, where now you can then use that perpetually for gas, the utility that it provides, giving access to our platform as well as the platforms of others. So now we have that benefit of anybody can use us without previous exposure to the token and the ecosystem, without having the extra expenditures of having to have 100 plus validators and having a whole bunch of emissions go to them, and then it's higher costs.
And basically what it comes down to with our decision to go on Archway is that we want to reward the people that are participating in Web3, the people that are building it, the people that are actively contributing liquidity on our platform. It's all about realigning those incentives. We collectively understand the need to focus on our growth catalysts and reprioritize reward placements. So it's just kind of same tunnel vision focus, you know?
And speaking of focus, what is the vision of Astrovault? So where do you guys want to be in 1 year, 3 years, 10 years?
Well, so in 1 year, I would very, very, very much like to be somewhere in the top 20.
Top 20 AMMs, top 20 on CoinGecko.
All of the above. No, I think probably top 20 AMMs. I think that's a reasonable goal. Beyond that, I think we could in the next 5 years see us as one of the top projects, one of the top AMMs to talk about, just simply because we will be so far ahead of everyone else in revenue. Granted, this is all speculation. This is not financial advice. This is not a but just having that hyper focus on revenue and really working on building a treasury and adding value to the token now is something that's going to set us far ahead of these people who are going to have to react to the circumstances that they've created for themselves. So we have the added benefit of being able to look at the market and really identify the problems and run simulations and figure out exactly what's wrong here. We didn't have to maintain a product while we were doing all that. All these people who have these products live are going to have to figure out the things that we already are indeed, and then solve backwards for that. So like Osmosis is going to have to figure out how to incentivize their node providers once their inflation runs out. It's a problem that we already thought about, at the beginning of this, but they're going to have to deal with it retroactively. So you see a lot of different problems like that, but we solve for them initially outright.
And so you guys are a layer 2. Are there any layer 3s building on you?
Yes, there are actually. We have a lending protocol building out on top of us, and with Archway's contract premiums, we'll be able to leverage those layer 3s and actually add revenue streams from them.
Yeah, we'll talk to the lending protocol here on the Arch podcast decently soon, but it'll be really neat. Part of what Astrovault aims to do, and really is the first protocol position to do, is leverage these one-to-one stable swaps to allow things like synthetics to trade literally one-to-one with the other assets, lowering the barrier of entry for these protocols, raising the margins for these protocols. It really will make DeFi run far more efficiently, and we only aim to be the AMM. Like there's a lot of things we could do, like, are you guys gonna do lending? Are you guys gonna do a stable coin? Like, we don't need to do all that. We want to be the AMM hub, and we want to partner with everybody else to take care of their AMM needs, because we can do AMM better and more efficiently than anybody else can. And we want to collaborate. We want to contribute. And the more trading we get, the more liquidity we get, it raises our revenue, it raises our margins, it raises our foothold in the Cosmos and larger community. So we're happy to facilitate other people building on us. If you guys are listening to this and you're building another DeFi protocol, be it on Archway or anywhere else, specifically in the Cosmos ecosystem, would be great and the easiest to integrate. But we can probably find a way to help you guys run more efficiently and more profitably, just because of how efficiently we run the AMM.
So tell me about the team. How big is it right now, and what is everybody doing? And
approximately 12 people. We are just heads down developing, heading into the new year. We've been at this for a while now, and we're just working on finishing things up and getting the audits taken care of, and just kind of keeping our noses to the grindstone in the meantime.
Yeah, we've got 7 developers, a couple marketing people, a couple designers, a brilliant 3D designer that makes the coolest stuff. we don't think that the metaverse is a good service in and of itself, but a lot of cool things can integrate the metaverse to have a better customer user experience. And we will have some cool things coming in that route as well. But yeah, we just a ton of talented people that really believe in the vision and are excited and dedicated to seeing it come to fruition.
Okay, great. And so how are you guys going to benefit the Archway community?
Well, definitely all of the liquidity we host will help gain attention. I find it very hard to believe that we wouldn't get a sizable amount of attention once they start to see those numbers line up. Just for starters, as far as drawing in other projects and things like that, we're going to be doing a lot of collaboration and outreach. There pretty much isn't an entity in the cosmos that we can't work with. So, and we have a collaboration growth mindset. So we're pretty much going to everyone and seeing how we can benefit them directly. Like what can we do for you? Rather than it being a conversation of here's what we can offer you, throw us some money. It's what can we do for you?
And it's not just bringing liquidity to the chain, which is something that a lot of chains are interested in right now. A lot of VCs are like, oh, how much TVL's on your chain? Just like they want you to be the host of it. When, as we know, we're approaching a multi-chain future, that where that liquidity is hosted is a lot less important than how it's used. But we are going to try, if we're able to get a significant amount of Arch-based liquidity, which we anticipate, we are going to try to make Arch the base pairing for most of what we do on Astrovault and for the Cosmos ecosystem as a whole. So we think Archway is being built and positioned to be the leading layer one in the Cosmos ecosystem. And we think that the Cosmos ecosystem has the best technology. And so we would like to earn a lot of Archway as part of our model would allow us to. And since if that's the token we have a lot of, then it's going to make a lot of sense to take 1 million Arch tokens and however many Atom tokens it is, and then throw that together in the X Arch, X Atom pair. Because as our plasma pools build, as we get more and more protocol owned liquidity, our DAO will basically take from these plasma pools and add them to the Nebula pool as it grows. And so we're hoping to make Arch the base pair for Cosmos.
Okay, great. And so it's almost around that time. So what is one thing that you guys want the audience to know?
As far as what I would want people to know, that would be that we offer low risk opportunities to earn in DeFi. And we are here in a bear market still, building, working hard, and we're going to continue to be here. We're not going anywhere. And if you guys want to connect with us, you can go to astrovault.io and get a link to our Twitter. You can follow me on Twitter. I have my link right up there in the corner, or join our Telegram.
Yeah, we're here. We're on Archway. We're committed. We were committed to being on Archway before I joined Phi Labs, but it's been an honor getting more connected with the team. They're seeing how brilliant, how hardworking they are. We know that Archway is here to stay, and we're planting our flag, and we're honored and excited to build and contribute to the beautiful ecosystem it's blossoming out to be.
Yeah, well, I look forward to LPing on Astrovault once it launches. So looking forward to that. Eric, Ethan, thank you so much for joining. And everyone, thank you so much for tuning in. We'll see you next time.